Yes, you've seen it correctly. Let's talk about two stocks that are down 90 and 60% respectively. Both of them have already reported their latest quarterly figures, so we can look at that. One stock went down 15%, the other one went up over 20%. So let's discuss what exactly has happened. The first one we're going to talk about is Fiverr. Fiverr was up over 20% during that day. Now, at the time of making this video, it's up 19.28%. Has a market cap of just $1 billion. Year to date, down 4%. Year over year, down 13.3%. But in the last 3 years, stock is down close to 90%. Now, of course, Fiverr during the pandemic was a fast growing stock. Right now, top line growth, we could be happy if we're seeing something close to 10%, which is what the analysts are expecting for fiscal year 2025. 2026 expectations are closer to 13.3%, but bottom line is expected to outgrow the top line. And free cash flow, well, free cash flow is doing quite well as well. We're also getting some numbers for 2027 from the company, or at least what they're expecting to do up until 2027. Right now, the average analyst price target sits 20% higher than the price we're at today. No real changes to the average analyst price targets, even after the recent earnings reports. Overall, what you can see from this business over the years is that revenue has increased, but of course has not increased as fast as before. Free cash flow has been positive and has been growing quite nicely, actually outgrowing revenue growth. Gross profit has grown as well. Net income has become positive. But the big issue still here is that, well, SBC as a percentage of revenue still sits around 19 to 20%. So that's not that great. Then looking at some valuation metrics for PE, EV to EBITDA, price to sales, price to free cash flow, of course, not expensive at all. And so before jumping into the earnings report and a couple of things that were mentioned during the earnings call, especially a new acquisition, which to be honest, I did not see that one coming, but let's discuss that. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first up, I want to touch on the acquisition that they made. It's an acquisition of a drop shipping service company. Yes, I know, pretty strange, right? Let's have a read here. So founded in 2018, AutoDS provides a subscription-based end-to-end solution for dropshippers, including product research and sourcing, inventory management, and automated fulfillment. With its expansive global reach and an omni-channel approach, it aggregates over 150 million products and serves tens of thousands of paying subscribers on its platform. The acquisition brings tens of thousands of dropshippers into the Fiverr ecosystem, adding to its existing dropshipping and e-commerce buyer base. Commenting on the deal, Fiverr founder CEO said the acquisition also marks another step in Fiverr's transformation from a marketplace into a powerful platform that offers not only access to talent, but also software solutions for its audience, making it a one-stop shop for their entire digital needs. AutoDS will remain independently operated while working together to maximize synergies between both companies. So here you're getting a little sneak peek to where Fiverr wants to go. They continue by saying in the earnings call, while dropshipping is not exactly a new business, with the rise of fast fashion e-commerce sites like Temu and Shein and the continued strength of social media, we are seeing dropshipping related categories experiencing tremendous growth on Fiverr. That includes Shopify development, by the way, that's already good commentary for Shopify, e-commerce management, video ads, and UGC videos, to name a few. We believe the deal can create many synergetic opportunities for us to lean into growth. Lastly, and in alignment with our expansion to a platform play, we are taking the opportunity to fold in a new subscription-based revenue stream with strong synergy and growth potential. This will add to our value-added product portfolio, which includes promoted gigs and Seller Plus, and further strengthen our business's overall financial profile. Look, this could be interesting, so let's see how it plays out. And so for the quarter, these were the numbers. Revenue increased only 6% year over year. Gross margin on a GAAP basis, 83.1%. Non-GAAP, 84.4%. Active buyers decreased 8% year over year from 4.2 million to now 3.9 billion, but spend per buyer has increased 10% year over year. Take rate still very, very nice, 33%. That's a 330 basis points year over year improvement. Adjusted EBITDA margin of 18.9%, adjusted EBITDA $17.8 million, and GAAP net income $3.3 million. For the quarter, they say here that cash from operating activities was $21 million, up 12% year over year. Free cash flow was $20.7 million, representing a 13% year over year increase and a 22% of free cash flow margin. As for the financial outlook for Q3 and fiscal 2024, so for fiscal 2024, let's start with that. The numbers are a little bit better. They're now expecting revenue growth of 6 to 7%. The prior one was 5 to 7%. As for adjusted EBITDA, the lower end got an increase of $2 million, so now expected to be between $69 to $73 million. As for Q3, they expect revenue growth of just 3 to 5% year over year and adjusted EBITDA to be between $17 to $19 million. To end here the Fiverr part, they say cumulatively we expect to generate over $300 million in free cash flow over the next 3 years, representing an increase of over 50% compared to free cash flow expected in 2022 to 2024. We will also consider strategic high return opportunities, which can include incremental buybacks. They did $100 million in buybacks, by the way, delevering our balance sheet, and M&A opportunities. This gives us the ability to optimally balance growth and profitability in order to achieve a consistent upward trajectory for free cash flow per share. Then they give us this, it's the first time I'm seeing this, driving compounded free cash flow growth at 14% CAGR through 2027, so approximately 25% adjusted EBITDA margin in 2027, over $300 million cumulative free cash flow for the period 25-27, and over 14% free cash flow CAGR during the period 24-27. So overall, good quarter. My mind has not changed that much with regards to Fiverr. It's a good company, very profitable company as well. And no, I've seen these comments before. I don't think that ChatGPT is ruining their business. Listen, there are plenty of folks that do not know anything about ChatGPT or how to use it. Plus, ChatGPT does not create websites for you just yet. By the way, it does not manage your websites, drop shipping. Logos aren't great either because the editing, you have to do it yourself. So why not just pay someone a couple of bucks and you're done with it? So I don't think that's a valid argument. Maybe in the future, yes, remains to be seen. Overall, I've sold Fiverr quite a while ago because, well, this is not a growth story anymore. Although it became more profitable, I saw better opportunities elsewhere. But again, good company right now. If we actually look at the graph, from a risk-reward perspective, I don't think you can go wrong. But yeah, I mean, is it a growth company? I don't think so. Is it becoming more and more profitable? Well, definitely they are. Question here is this the best that you can get in the market right now? Yes, it has been creating a base here around these prices for quite a while. It's now over the 200-day moving average. Let's see if we can finally stay above that. But again, great company, good stock right now, risk reward wise, but are there not better options in the market? In my opinion, there are. So that's the Fiverr part of this video. Second stock I want to touch on is Pinterest. Now, Pinterest dropped 14.46%, has now a market cap of $21.8 billion. Year to date is down 13.7%, has a forward PE of 20.5 times. Now, Pinterest had a good quarter, but again, guidance not great, and so you get punished. Now, with regards to Pinterest, unlike Fiverr here, growth, top and bottom line look a bit better. Sales growth of around 16-17% on average for the next coming fiscal years. EPS growth much faster, 32% fiscal year 2024, 23% in 2025, and close to 30% in fiscal year 2026. If we look at the current average analyst price target, that still sits close to 40% higher than the price we're at today, despite the recent drop in price and average analyst price target after the recent report. Looking at some valuation metrics here, again, it is cheaper on them all based on the 3-year mean forward PE, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth, 0.53. So definitely on the cheap side. And so here as well, overall, we can see that revenue was, let's say, stable for a while, but now we're seeing a small reacceleration. Free cash flow is recovering as well, has been positive for quite a while. Gross profit continues to grow, not that fast, but continues to grow. Net income, there was a period where it was net income negative. We're back in the positive, but here again, SBC as a percentage of revenue is above 20% in the last 12 months. Definitely something to keep an eye on. And so for this quarter, let's start with a comment from the CEO. We had another impressive quarter reporting a 21% increase in revenue and 12% growth in monthly active users globally. Our monetization efforts are paying off. Advertisers are seeing improved performance across key objectives on Pinterest, from brand awareness to conversion, as we continue to roll out AI-powered products and experiences. As a result, we're gaining share of advertising budgets with some of the world's largest brands. I'm proud of our pace of innovation as we execute against the opportunity ahead. So, revenue globally increased 21%, in US and Canada 19%, in Europe 25%, and rest of the world 32%. Of course, as you well know, rest of the world is not as monetizable as US and Canada or Europe. As for monthly active users, that continues to grow, reaching now 522 million, increased 12% globally, 3% US and Canada, 9% Europe, and 17% rest of the world. And here you can basically see it visually. Average revenue per user, or ARPU, increased 8% globally year over year, 16% US and Canada, 14% in Europe, and 13% rest of the world. As you can see, rest of the world ARPU 13 cents. Even Europe is still very, very small compared to, low compared to US and Canada, $1.03. US and Canada is at $6.85. Then looking at non-GAAP costs and expenses, stays about the same, right, as a percentage of revenue, so that's fine. Adjusted EBITDA increased 68% year over year and over 600 basis points of margin expansion year over year. During the call, they did ask for more information with regards to Google and Amazon, their third-party partnerships. So with regards to Google, it has a very, very big positive effect on the rest of the world segment. Said here, we did see a nice acceleration to 36% on a constant currency basis, up from 26% the prior quarter, albeit of a relatively small dollar base, talking about the ad market. Revenue, the primary factor that drove this acceleration, was the ramping of the Google third-party partnership that we announced in Q1, began to ramp in Q2. And as a reminder, this is allowing us to monetize what was previously unmonetized markets. And we're now also starting to expand into countries in our rest of the world segment that we were under monetized in. So we're pleased with how that's beginning to launch. As for the Amazon part, they say we're still relatively early days in what we're doing with the third party. We're a little bit more than a year in from when we first announced that early 2023, and we've seen Amazon ramping nicely. Google were much earlier on with that as we announced them roughly a year after Amazon, and that's starting to ramp as well. And so we continue to see each of those build as we shared in our commentary, that Q2 build off the baseline that we saw in Q1. We have similar expectations of that going forward, so we continue to see those things as a steady build. Analysts were expecting a clear answer on how Amazon is performing, especially ahead of the holiday season later this year. And so looking at the graph for Pinterest, still unable to go above that downtrend line, which started here basically at the peak, February 2021. It tried, didn't succeed. Right now we're back under the 200-day moving average, which sits at $36.86. RSI is getting pretty low now. This is the uptrend line, so higher lows. Maybe it can stay above that. But Pinterest definitely, in my opinion, a better pick if you want to choose one of the two, because it is growing faster. Advertising becomes, we know how profitable advertising is, becomes a bigger part of their overall business. They finally figured out how they monetize their users. It might hurt the user experience, let's be honest, but so far, no signs of, having less users on the platform, because the platform is growing, they're making more money, they're growing, so I think things are moving in the right direction. Top and bottom lines are improving as well. So if I had to choose, it's probably going to be Pinterest. But then again, I don't hold any of those companies anymore in my portfolio because I thought there were better options out there. And there were. So that's just my opinion right now. I just wanted to go over these two companies because a lot of you have commented on Pinterest and Fiverr. So here's the recap. Do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.